Hello and welcome to Earth911's Sustainability in Your Ear, the podcast conversation with a changemaker working to accelerate the transition to a sustainable, carbon-neutral society. I'm Mitch Ratcliffe, your host, and I'm pleased to have Newday Impact Investing CEO Doug Heske back on the show to talk ESG investing. That's environmental, social, and governance investing. With the markets in an uproar, the S&P 500 fell 21.8% from its highs this week, inaugurating our first bear market since March of 2020. We want to talk about how investors interested in the sustainable transition can respond to market mayhem. But Doug also has some news of his own, too. Newday Impact just announced its first exchange-traded fund, or ETF, the Newday Ocean Health ETF, which trades on the New York Stock Exchange under the symbol AHOY, H-A-H-O-Y. It's the first sustainable investing ETF from Newday and represents a new direction for the company. The Ocean Health ETF investment strategy is based on the United Nations Sustainable Development Goals and excludes companies that are not making legitimate efforts to reduce their ocean and environmental impact. Newday partnered with the nonprofit Earth Echo International, established by Philippe and Alexandra Cousteau, to lay out the criteria for selecting the stock included in the Ocean Health ETF. You can learn more about Newday Impact Investing at newdayimpact.com. That's all one word, no dash, no space, newdayimpact.com. Welcome back to the show, Doug. How are you holding up in these wild market times?
Mitch, we are hanging in there, and it's great to speak with you again. I'm actually dialing in this morning from Park City, Utah, where we are speaking at what is an impact conference run by the Sorensen Impact Foundation, and we have a beautiful day here. There's a little bit of new snow on the peaks around us, and it feels great to be back in Utah.
My old stomping grounds. I wish you well while you're there. It's a wonderful place. Now, you've got some good news, but I want to start off with the ugly backdrop against which everyone is making decisions right now. The economy, despite a wealth of cash in households and labor shortages, is sinking under the weight of inflation and the Ukraine war's impact on fuel and food prices. So I wanted to start off by asking you, what do you think the main drivers of the panic are, and are they going to last?
Yeah, so certainly we are in the midst of very challenging times right now. Mm-hmm. And everyone is feeling the pinch. Let me take that back. Everyone is feeling the punch. Gas prices are setting new records every day. Food prices are on the rise. Virtually everything feels more expensive. In the first quarter of this year, I flew round trip to New York City from San Francisco for under $300. And that same ticket today can cost more than $1,000. So the panic right now is really all about inflation fears. Mm-hmm. That has now found itself in this position of being way behind the ball, and as such has stated that it will do everything in its power to combat inflation. So we saw this as evidenced in the CPI number last week, certainly much higher than everybody was expecting. I think the message that it has sent is that the Fed is going to be prepared to raise interest rates several more times this year. And this next rate increase maybe is potentially as high as 75 basis points. The backdrop to all of that is that, with the Russian-Ukrainian crisis, now appears to be staged to drag out for many more months. So record energy prices, the highest inflation we've seen in 40 years, and looming recessions in Europe and the U.S. promise for what likely will be a very long, hot summer and potentially an even colder winter. So, the financial markets tend to be this leading indicator and a great forecaster of times to come. And the markets are telling us right now that there's more bad news on the horizon. How much of this is baked into securities prices today? Some of it, but maybe not all of it. And I think the markets have probably discounted a 50 basis point rise in the Fed fund rate, but not likely 75 basis points.
I've seen discussions as high as a full point, and I do believe that the market is reacting to that concern. What I'm confused by is there doesn't seem to be much demand contraction because people are just getting back to life after the pandemic and they're starting to spend, particularly on services. Where do you see genuine weakness in the market right now? Or are people primarily responding in a fear-based way to the news, the discussion about what the Fed's going to do?
Yeah, and I think that that's right. There doesn't appear to be a lot of demand contraction, at least not yet. But times like these have a way of eating into consumer confidence, right? Mm-hmm. So there's a lot of paper wealth that's been accumulated over the last number of years in the equity markets, but consumers are going to err to the conservative side, especially with the backdrop of all of this negative news, especially if markets stay sideways or deteriorate further from here. So what does not appear to be impacted yet is travel. I mean, I came through San Francisco yesterday, and the long lines were as long as I've ever seen at the airport. So I think that this is a factor of people being in lockdown for the last couple of years, and people have said, this is the summer to get out and travel, which is part of the reason why we've seen this escalation in air tickets and a number of other things as well. So I think that we are in a real period of uncertainty right now, and I think that the markets are telling us that as well.
Well, let's talk a little about Ukraine, because the war has contributed to this in a variety of ways, to increased oil prices and gas prices. Food prices are rising as well. But the question I want to get to is, do you see this spurring new oil and gas exploration, or is this going to actually accelerate the path to renewables and the adoption of solar, wind, and other alternatives to petrochemicals?
Yeah, I think that it's a good news, bad news situation. And I think you're right. And the answer is yes to both. I don't think there's any question that this is going to accelerate our efforts to become less dependent upon foreign oil. But for those organizations and individuals that are battling against fossil fuel extraction, this is a pretty big negative short term. $120 a barrel for oil can fuel a lot of new exploration and extraction. I think that the question will be twofold. Is this a longer-term circumstance with reference to the rise in price, or a short-term circumstance? It doesn't feel like it's short-term to me. It also begs the question whether the rest of the world holds steady on not importing Russian energy, both before and after this crisis ends. Yeah. The U.S. has become far less dependent upon Russian oil. We only, as an example, import 3% of our energy from Russia. However, the rest of the world is far more dependent, and consequently, prices have risen dramatically. It costs more for everything right now, and it's more expensive to produce and even ship everything as it relates to that escalation in energy prices.
Does this suggest a change in the way that investors should think about their strategy? Are we moving away from Fed-fueled stock prices rising consistently over the course of the last decade to one in which they need to blend higher dividend yields and price appreciation to maximize the return on their investment?
I think anytime you have a dramatic shift in financial markets, a dramatic shift in economic circumstances, it begs the importance of readdressing what your strategy is. Mm-hmm. And, for decades, we've seen a deterioration or a fall in interest rates, and that certainly does not seem to be the case as evidenced over the last number of months. There has been a shift from more growth-oriented companies to value companies. I think that whenever you get into a more challenging economic environment, people are looking for more stable generating earnings. Mm-hmm. From companies. So we've seen that shift. As an example, we've seen a massive a drop-off in prices associated with tech, right?
Right.
And I think that we're now getting down to levels where the valuations of some of these companies are much more reasonable. I think, as always, if you're a long-term investor and you're buying great companies, you buy great companies for the long term because, they're growth companies, right? It's just, you've got to be able to live with the volatility in the short term.
It takes a lot of nerve, though, and that's really the test at this time for a lot of investors who have never been through anything like this before. I mean, I remember this kind of inflation from the very beginning of my career, but it's been gone for so long that it's shocking.
Yeah, there's that adage of stepping into or in front of a moving freight train or catching a falling knife. And that's, emotionally very, very difficult to do in markets like this where we're down 21%, and we've seen these big down days like 800-900 points, right? And that's a scary situation to be in. And I think that investors should be thinking about this in a reasonable way, in an unemotional way, based upon where valuations of companies are, and make the decisions about the companies that you want to own over the long term. And if you do that, I think it will pay off over the long term.
So don't try to time the market, choose the best value and average in over the course of time.
Yeah, and I think that is certainly a strategy that we deployed at our organization. And we are focused on organizations that demonstrate really positive attributes relative to environmental, social, and governance characteristics. But there have been times that there are great companies that support that mission, but it's a bad time to own them.
Yeah.
So there have been times over the course of the last couple of years that we've looked at Beyond Meat, but the valuation on that company was just too extreme for us to give consideration to putting it in the portfolio at a particular time.
So how have ESG stocks performed in recent weeks? I guess the question is the party over?
ESG stocks are defined as companies that are doing really good work for all of their stakeholders, right? Mm-hmm. I don't think there's any questions really over the last quarter that portfolios that have not had exposure to energy have been hurt. Portfolios that have been heavily exposed to tech have been hurt. Mm-hmm. But this has little to do with the long-term prospect of a company. Companies that are responsible stewards, that safeguard, their resources for all of their stakeholders over the long term will be great performers. So again, longer-term investors should be asking the question about the future of companies that contribute to exacerbating the climate crisis. They contribute to the social incohesion that we're witnessing today. Mm-hmm. And as an example, manufacture firearms that end up in the hands of people that shouldn't have them. So it's ESG is a framework from which people should make great investment decisions, but not a product classification. So this is just part of the process that investment managers and fiduciaries should be going through to make good decisions about which companies to own. So if you're talking about ESG companies relative to renewables or portfolios, that don't have fossil fuel exposure, yeah, this has been a really tough quarter. But I'll say this again: companies that are great companies that are good stewards of community resources outperform over the longer term.
Your point about this being the method for screening stocks is an important one. There's been a lot of criticism of ESG as a practice lately because it's primarily applied as a label, which is certainly subject to greenwashing. Former BlackRock Chief Investment Officer Tariq Fancy says that ESG is essentially greenwashing. Do you think we're at an inflection point with regard to the relationship the market has with ESG as a practice? Are we going to see some changes?
I think that we will see changes, and I think Tariq Fancy is justified in his criticism of certain organizations. Mm-hmm. And I think that there's a lot of misunderstanding in the general marketplace about what ESG is. And I think some of the skepticism and criticism is very legitimate. You and I have discussed this before, but ESG is not necessarily impact. It's a framework from which investment managers can make better investment decisions. But ESG can be impact if you're using ownership as a tool for change, mm-hmm. and contributing to grassroots organizations that are doing really powerful grassroots work. And that's the work of Newday. So we're partnered with organizations like Earth911 and the Jane Goodall Institute and many others as a mechanism for driving on-the-ground transformation, right? That they oftentimes are the best organizations to do that. But I want to be very, very clear about this, that for most organizations, ESG is not impact. But if organizations are using, especially as asset managers, their shareholder voice or stakeholder voice to advocate for change, it certainly can be.
I want to take just a short break, and we're going to come right back and talk more with Doug Heske. We're back and continuing our conversation with Doug Heske. He's the CEO of Newday Impact Investing. So, Doug, we're talking about ESG, but one of the big challenges right now for the nation is the political conflict that we face. And we know that Joe Biden has a hard job right now because he's getting blamed for everything going on. And that could lead to a Republican sweep in the fall. What does that potentially mean for ESG investing? Will it change the environment, and will it change where policy is going in terms of supporting environmental progress?
Yeah, it's, over the course of the last over the last 10 years, we have said repeatedly that I can't imagine a more divisive environment. And certainly all of these issues that we've been talking about are adding to that. I think that it's too early to specifically forecast what will happen in November. But the point to note is that people are definitely going to vote with their pocketbook, as they always do. And there are a lot of people that are struggling out there right now. And I think that there will be a lot more before all of this is over. I don't think that it looks very good for Biden right now, but a lot can change in 5 months. It also depends on who he's running against. So, your question around what this means for ESG is a really important one. There's been a lot of money made in the energy space over the last couple of months. There has also been a lot of money that's been left on the table by those that did not have exposure to fossil fuel companies. Mm-hmm. And unfortunately, there's been some backpedaling by a number of major financial institutions and asset managers on ESG who have said, maybe we're moving too fast. I mean, what a joke. We had an entire industry waving the ESG flag when it was in their financial interest to do so. But now that it's not, they're singing a different tune. One thing that I can promise you, Mitch, is that global warming doesn't care. Water shortages and drought don't care. Wildfires don't care. Food shortages don't care. And these existential threats are coming. They're coming. I know they're coming, and they're not slowing down.
And we're fueling them.
So I don't think that ESG will change for those who are truly responsibly minded and committed to helping our world. ESG will change for the opportunists, and it already has. So, for us as an organization, we're committed to this idea, as we have said repeatedly, of investing in great businesses. So, great businesses leave a lasting imprint on the community. They generate extraordinary wealth for their shareholders. But for us, ESG is not an asset class. It is an important factor in how we invest in companies and the determination that we make as to whether a company is a bad company or a good company or even a great company. And that's the work that we do at Newday.
So let's talk about the Ocean Health ETF. You just launched this in the past week at the New York Stock Exchange. It trades under the symbol AHOY. What makes a great ocean health company to invest in?
Yeah, so maybe just to start this piece of the conversation, we had an incredible week last week. That it was our first exchange-traded fund listing on the New York Stock Exchange. And it was an opportunity for us to communicate, certainly to the world, the work that we do around ocean health and why we do it around ocean health. As you identified earlier on in the conversation, we have a very close relationship with an organization by the name of Earth Echo International and the Cousteau family, Philippe and Alexander in particular, who run that organization. So what makes a great ocean organization is one that is either directly or indirectly supporting ocean health, whether it pertains to activities that they are putting into practice related to the reduction of greenhouse gas emissions, or whether it be putting in actual practices within the business to curb the production of plastics that end up in our waterways and our oceans, or even organizations that are developing responsible behavior related to sustainable fishing and aquaculture and things like that. The Newday Ocean Health ETF is a combination of all of these types of companies, and about 92% of all of the companies in the portfolio have either a direct or indirect impact on ocean health.
And what do the fees look like? Just a lot of people are concerned about additional fees for ESG funds. What are your management fees?
So on the Ocean Health Exchange Traded Fund, the annual expense ratio is 75 basis points.
Okay.
And, I think that is very much in line with where other active exchange traded funds are priced.
Mm-hmm.
We, as we have discussed, are an active manager. We think that is more consistent with our cause of ESG and impact. We want to make sure that we have teeth in the equation relative to exacting influence over the constituents, the companies that are a part of our portfolio.
So what is the role of Earth Echo International in the stock selection process? Because Philippe Cousteau obviously comes from the most ocean-centric family in history, as far as I can tell. Are they contributing an analysis to your organization?
Yeah, Earth Echo doesn't have any role in portfolio construction or the ongoing management of the portfolio. However, we are depending on them and their deep insights that are provided more generally about what's going on in the ocean health space. They are extraordinarily well connected. They understand the science behind ocean health. They understand some of the new innovative technologies that both public and private organizations are working on to support the health of our oceans. And most importantly, the relationship with Earth Echo International is about education and advocacy. As I think you may know, they are building a global youth movement. That's super important because the younger people that are part of this organization will be the leaders of tomorrow. And we have, over the course of the last 5 years, had lots of conversations with older people. And some of them say, frankly, I'm too old to get involved with this, but I'm doing this for my grandchildren or my children. And I think that's really important.
Certainly, that's one of the things that motivates me. I don't think about myself anymore. I think about my kids and their children and their children's children. It's important to take this long view. Why did you choose Ocean Health to launch your first ETF? You have been doing work across a variety of ESG categories. Why this one?
For one simple reason, that ocean health is so foundational to everything else that we work on, that oceans are the lungs of the planet. We hear from time to time that the Brazilian rainforests are the lungs of the planet, but the oceans have the capability of absorbing every ounce of CO2 that's currently in the atmosphere right now from a technological
and all the heat too.
Exactly. So if ocean health continues to deteriorate, then we've got a much bigger problem. So nothing else really matters. And so we wanted to begin with oceans because of that connection, because of that inextricable link between global warming and this ecosystem that's so foundational to supporting it.
Earth has a chest fever, to put it mildly. I mean, the Earth has packed a lot of heat into the oceans. That is going to change the chemical makeup of the oceans. We may lose fisheries. Well, we are going to lose some fisheries. We know that for sure. This is great to see you do this kind of focus, but I have another kind of practical question, and that is because you launched this ETF at the time you did. How do you deploy the capital that you have? Are you holding off to wait for better prices, or are you starting to just build a portfolio based on the right companies at the prices they are today?
Yeah, so we are, as an exchange traded fund, fully invested.
Okay.
my advice to clients would be that, like in any other market, it makes a lot of sense to take a more cautious approach to investment decisions, especially during periods of market turbulence where we've seen over the course of the last couple of months. But a great way to do that is through dollar cost averaging. And we have a lot of the families and foundations that we work with have employed that strategy. So, you're taking the pool of capital and dividing it up over a period of time and coming in with over a regular period to make investments into the particular investment that you want to own.
How has the uptake of the ETF been? Are people moving into this stock?
Yes. So there's been a lot of initial excitement and certainly a lot of media coverage over the opportunity now to invest and support the oceans. It is the early days, so we have a lot of work to do from here. We have a number of major, well-recognized families and foundations that are coming into the Ahoy ETF. But this is a long road as well. Like, we're not here over the course of the next couple of months to grow to $1 billion in assets. That this exchange traded fund is going to be around for a long time. And, we hope that people, as they're giving consideration to making impactful investment decisions, will give consideration to the ETF, especially if you support the health of our oceans.
So what are you thinking you're going to add next? Obviously, this is just the first of many ETFs. Where can you make the biggest difference next?
Yeah, so we are, as you know, focused on a set of environmental issues, things like ocean health and climate action, wildlife conservation, and then a whole set of social issues and impact initiatives as well. We're running 8 investment portfolios today that are run as separately managed accounts. They're not run as unitized products like exchange traded funds or mutual funds. But we do expect over the course of the next 12 to 24 months to bring new products to market with a particular focus on these same issues as a mechanism for democratizing access to values-based investing. We have a number of things on the drawing board. One of the areas on the social side is a focus on diversity, equity, and inclusion. We expect over the course of the next 6 months to do or bring a new product to market. And then the other big initiative that we're working on is with an organization that is directly supporting quality education and youth skills development for tens of millions of youth around the world. And we have a very exciting program that we're going to announce later on this fall or in September of this year in New York City in conjunction with another major event. So stay tuned. A lot of exciting announcements that will be coming over the course of the next few months.
Well, I'm looking forward to our next conversation because we were going to continue the discussion about empowering youth globally to solve the climate crisis. And so looking forward to hearing that. Let me just ask you to look ahead, say to 2025. What would you tell somebody asking you today what the markets and the economy are going to look like in 3 to 5 years?
3 to 5 years is a long time from now. And, just to reinforce this idea again, I think that now is an opportune time to be adding positions in companies or sustainable investment products that you want to own for the long term. And it's tough to do right now, especially given this volatility. But I think that 3 to 5 years from now, people will look back and be very pleased that they took advantage of valuations in the current market. Again, businesses that are great businesses aren't going away. And these types of businesses that we characterize as great businesses develop what we call contingent assets that are not typically reflected in financial markets. And market inefficiencies are driven by these sort of excess factors that we evaluate. An evaluation of these extra financial factors reduce risk, but also uncover alternative sources of excess returns. And I think the market oftentimes underappreciates the impact of these extra financial factors. And this is an inefficiency, certainly in market periods like this, that can be exploited. So companies longer term that behave well, perform well. And the decisions that people make today for the long term are to be invest or should be investing in these types of companies.
Well, Doug, thank you. It's always fascinating to have a conversation with you, and we hope you'll come back soon.
Thank you, Mitch. This is great. And anybody that would like to learn more about the Newday ETFs, go to newdayimpactetfs.com. Always happy to have personal conversations as well.
Great. We will add that to the article, and so everybody can find it.
Great. Thank you, Mitch.
We've been talking with Doug Heske. He is the CEO of Newday Impact Investing, and you can learn more about the Ocean Health ETF at Newday Impact ETFs. ETFs is plural, newdayimpactetfs.com. It's always fascinating to talk with Doug because he has a very pragmatic view of what's going on in the markets and with regard to companies' impact on the environment. You know, he used the phrase in the conversation about the ESG controversies that the way some of these companies are behaving is a joke. And that is that they're putting a label on an ESG fund or an ESG stock and saying it's all safe and good. But the fact is, ESG is a mechanism for decision making, and it's imperfect. It's something we can improve. And everyone, I think, is working to begin to make those improvements. But the question remains for all of us, if we are investors in the stock market, whether we are simply going to focus on profitability or profitability and improvements in the way that the world works and the environment and the restoration of the environment. So, folks, if you want to be in the driver's seat, think about putting a little of your money behind a company that you believe and can prove, based on the data that they share, is making a positive difference for the planet. This is Earth911, Sustainability in Your Ear. I'm Mitch Ratcliffe, and we're going to be back with another innovator interview soon. In the meantime, I hope you'll take a few minutes to share this podcast and all the others that we've done with your friends and family, people that you work with. Let's get the conversation started so that there are more ideas out there and we can have less waste. We'll be back soon. Take care of yourself, take care of one another, and let's all take care of this beautiful planet of ours. Have a green day.